I think one of the things that our clients need to understand today is that there is momentum in the sales of retail investment properties. We've been very successful currently and in the past few months of executing a lot of single tenant properties, a lot of properties that have existing financing, and others even on an all cash basis in the marketplace today. We were talking earlier this afternoon, and in the past week or so, we've put 8 properties in escrow. If you talk to most people, they'll tell you that there isn't much activity going on in commercial real estate, but there really is a lot of activity. Creative opportunities out there for developers and lenders in today's world is what we call the breakup strategy. The breakup strategy is one where we're taking a existing shopping center that is either parcelized or can be easily parcelized and selling off the various elements of the property to individual investors. The reason for this is that we can take a $30 or $40 million shopping center anchored by a grocery anchor and be able to break that deal up into much smaller deals. The buyer pool for a $40 or $50 million deal today without financing is limited. However, there is a much larger buyer pool for smaller properties in the $1 to $5 million category. And these include sit-down restaurants, fast foods, even smaller shop buildings where the buyer pool is coming in and paying cash. I think that the breakup strategy works well for the developer. It also works well for the lenders. We've shown in many cases and in current projects that we're working on whereby we can minimize the exposure on a loan by using the breakup strategy, selling off the parts at much higher prices than the whole would receive in the market today. Again, the same strategy, but we've seen situations where we're dealing with $30 million loans that if you were to purchase the property in whole, the property might be worth $6 or $7 million less than the loan because of the potential vacancy in the shop element of the property. By selling off the pads and breaking the property up, we've been very successful in maximizing value and even in the case of a $30 million loan, being able to pay the loan off in full and have equity left over for the developer. This is a 30 to 40% swing in many cases due to the fact that the smaller properties are still selling in the 6 and low 7 cap rate range, and the whole properties where there is a substantial vacancy in the shops are selling for much higher cap rates.